Project financing 2. Define fund and its types. Funding means the money needed to start, operate, and grow a business or project. It is used for things like product development, manufacturing, marketing, office setup, hiring, and inventory. A business can receive funds from one investor or multiple investors, and the control/governance depends on who funds it and the business stage. Some startups prefer not to take external funding so they can avoid debt and keep full ownership, no equity dilution. But many startups do take funding as they grow and expand. White heavy checkmark comparison between funding and sources of funds. Point of comparison. Funding sources of funds, SOF, meaning funding refers to the money required to start, operate, or grow a business or project. Sources of funds refer to the places or origins from where that money is obtained. Purpose: to finance business activities like production, marketing, salaries, expansion, etc. To identify how or from where the business gets the required money. Focus focuses on need and use of money. Focuses on origin and nature of money. Scope includes all types of financial support, grants, loans, investors, etc. Includes classification of funds based on time period, ownership, and generation source. Control/ownership depends on who provides the funds, e.g., investor, partner, or self-funded. Depends on whether money is owners, equity, or borrowed, debt. Repayment: some funding types need repayment, loans, while others don't, grants, equity. Depends on the type of source. Borrowed funds must be repaid, internal funds don't. Duration may be short-term or long-term depending on business needs. Classified as short-term, medium-term, or long-term sources. Examples: government grants, partner funding, loans, investor funds, crowdfunding, donations, revenue funding. Long-term: shares, debentures, medium-term, bank loans, short-term, trade credit, overdraft. Ownership relation includes both external and internal funding based on ownership preference. Classified by ownership: owners' funds and borrowed funds. Generation refers to acquiring money for a particular project or stage. Refers to the generation of funds, either internal, profits, or external, banks, investors. Decision level: managerial or financial decision on how to raise and use money. Accounting or financial decision on where the money comes from. Outcome: leads to creation or expansion of business operations. Helps analyze financial stability and financing structure. Types of funds for starting a project. Type: meaning, simple, government grant-free money given by government/organization for a specific purpose, no repayment. Partner funding: money comes from business partners who share costs, skills, and resources. Borrowed money: loans, money borrowed from banks or lenders that must be repaid with interest. Investors give money in return for ownership or profit share. Investor funds. Donations. People contribute money to support a good cause or idea without expecting return. Crowdfunding. Revenue funding. Selling up. Collecting small contributions from many people online. Using your own business earnings/profits to run or expand the project. White heavy checkmark. Sources of funds, SOF. Sources of funds means the origin or source from where money is received. For business activities. Selling the project/company to someone else when needed. Duration. Based on time period. Category. Long-term sources. Example: more than 5 years. Medium term. Sources: shares, long-term loans, 1 to 5 years. Bank loans, leasing. Short-term sources: up to 1 year. Based on ownership. Trade credit, overdraft. Type: meaning, owners' funds. Money invested by owners/shareholders includes reinvested profits. Example: share capital retained. Earnings. Borrowed funds. Money borrowed from outside sources. Bank loans, debentures. Meaning, internal sources. Type: buyers. 1. Funding equals money needed to start or grow a business. 2. Sources of funds equals the origin or way money is obtained. 3. Funding tells why and how money is used. SOF tells where money comes from. 4. Funding may include grants, loans, investors, or self-revenue. 5. SOF are grouped based on time period, long, medium, short-term ownership. Owners versus borrowed funds generation, internal versus external sources. 6. Funding can come from one or multiple investors. SOF shows variety of financial options. 7. Funding helps run or expand a business. SOF helps plan financial resources efficiently. Funding equals need and use of money for business. Sources of funds equals origin or source from where money is obtained. K2. Risk and uncertainty in project and types. Risk. 1. Risk means any unexpected event that can affect the project's goals, timeline, cost, or quality. 2. Risk can be positive, opportunity, such as completing early or getting extra resources, and negative, threat, such as delay or failure. 3. It can impact people, processes, technology, finances, resources, communication, or any part of the project. 4. Risks can be estimated because we can guess the probability, chance, of them happening and plan actions to reduce or handle them. Types of project risks. Operational risks, problems in production, process failure, late procurement, or day-to-day work issues. Security risks, data theft, hacking, unauthorized access, or system vulnerabilities. Legal risks, issues related to contracts, regulations, or disputes that may lead to penalties or lawsuits. Strategic risks, choosing the wrong project, wrong goals, wrong technology, or poor planning. Performance risks, when the product or project fails to meet required standards or expectations. Market risks, changes in customer demand, reduced market share, competition, or negative brand image. Uncertainty. 1. Uncertainty means lack of complete information, so the team cannot predict what will happen. 2. The outcome cannot be measured or estimated accurately, making planning difficult. 3. It exists when the project team cannot estimate the probability of an event, unlike risk. 4. Even when identified, the result remains unknown until it actually happens. Types of uncertainty. Variation. Natural variation within a known range, e.g., delivery time may vary by 1 to 2 days. Foreseen uncertainty. We know these uncertainties might occur, but we are not sure when, e.g., price change, supplier delay. Unforeseen uncertainty. Completely unexpected events with no prior warning, e.g., sudden breakdown, natural disaster. Chaos. When project goals, requirements, or assumptions keep changing and nothing is stable. Detailed comparison. Risk versus uncertainty. Point risk. Uncertainty meaning event may or may not happen, but probability is known. Future is unknown. Probability cannot be estimated. Nature known unknowns. We know the possible problems. Unknown unknowns. We don't know what can happen. Predictability somewhat predictable using past data. Not predictable. No past data or pattern. Information enough information is available. Little or no information available. Probability can be measured, e.g., 30% chance. Cannot be measured. Impact can be calculated. Impact cannot be measured. Management can be managed with risk management tools. Cannot be fully managed, only adapt and adjust. Decision making based on data, statistics, and experience. Based on judgment and intuition. Effect type can be positive or negative. Mostly unpredictable. Control can be controlled or reduced. Hard to control. Examples: cost overrun, system failure. Pandemic, new government law, sudden market crash. K3. Capital budgeting. Process/phases/objectives advantages/ disadvantages. S25. Capital budgeting. Capital budgeting is the process of planning and making long-term investment decisions in fixed assets like machinery, equipment, buildings, R&D, or new projects. It helps management decide whether a project is worth investing in and ensures optimal use of funds to achieve maximum profits and shareholder value. It is also called investment decision-making/capital expenditure planning. Objectives of capital budgeting: to select profitable and feasible investment projects, to control capital expenditure and forecast long-term funds required, to estimate cost and benefits in terms of cash flows, to ensure proper authorization and approval of investments, to coordinate project funds among departments, to maximize profits by allocating limited funds efficiently. Phases/process of capital budgeting. S25. 1. Planning. Generate and screen investment proposals. Decide strategic investment direction. 2. Analysis. Detailed evaluation of technical, financial, market, economic, and environmental feasibility, estimate costs, cash inflows, and profitability. 3. Selection. Compare alternatives using appraisal techniques. Select projects meeting required return criteria. 4. Financing. Arrange required funds through equity, debt, internal funds, etc. Consider cost, risk, flexibility, and tax benefits. 5. Implementation. Execute the project, engineering design, contracts and procurement, construction and installation, training and plant commissioning. 6. Review/control. Compare actual results versus projected results, monitor performance, and take corrective actions. Importance/advantages. Helps evaluate long-term investment plans scientifically. Identifies project risks and future returns. Ensures correct project selection. Avoids overinvestment or underinvestment. Increases shareholder wealth and long-term profitability. Controls investment cost and ensures proper cash flow planning. Disadvantages/limitations. Investment decisions are long-term and irreversible. Based on assumptions and estimates, cash flows, project life. High risk due to large capital involvement. Future market data may be uncertain. Focuses mostly on financial aspects, ignoring qualitative factors. Summary capital budgeting is a strategic financial process that helps organizations evaluate and select long-term investment projects. It maximizes profitability, optimizes resources, and reduces risk, though decisions involve uncertainty and large financial commitments. K4. Risk Management Process, S25. Risk management is the systematic process of identifying, analyzing, evaluating, treating, and monitoring risks in a project to ensure successful project completion with minimum loss and maximum efficiency. 1. Identify the risks. Identify types of risks that may affect project objectives. Use past experience, internal records, expert consultation, and external research. It helps the organization detect potential threats early and prepare solutions. 2. Analyze the risk. Determine severity and impact on business functions. Map risks to policies, procedures, and project processes. Develop a risk framework to understand potential consequences and reach. 3. Evaluate/rank the risk. Prioritize risks from highest to lowest severity, quality. High-impact catastrophic risks are ranked at the top. Helps management decide which risks need immediate action. 4. Treat the risk. Eliminate or minimize risks as much as possible. Consult experts in relevant departments. Apply methods such as avoidance, mitigation, transfer, or acceptance. 5. Monitor and review the risk. Some risks cannot be fully eliminated, so continuous monitoring is required. The project environment evolves, hence risk management is ongoing. Developing a risk-aware organizational culture improves adaptability. Techniques for risk management. Brainstorming, identifying possible risks using project records and team inputs. Root cause analysis, finding the origin of risks to solve real issues. SWOT analysis, detecting internal strengths/weaknesses and external opportunities/threats. Risk assessment templates, listing risks with probability and impact. Probability and impact matrix, ranking risks based on severity and likelihood. Risk data quality assessment, ensuring accuracy and clarity of risk information. Variance and trend analysis, comparing planned versus actual results to detect deviations. Reserve analysis, keeping contingency funds for emergencies. Conclusion: the risk management process helps organizations forecast uncertainties, reduce losses, and ensure smooth project execution. With proper identification, analysis, ranking, treatment, and monitoring, risks can be minimized and project success can be maximized. K5. Project Cost Estimation. Project cost estimation is the process of predicting the financial and other resources required to complete a project within its defined scope and timeline. It involves calculating costs for labor, materials, equipment, facilities, and risk reserves to determine an accurate project budget. Cost estimation is essential because it helps in budget planning, cost control, resource allocation, and ensures the project is completed within financial limits. A reliable cost estimate prevents overspending and increases the chances of project success. Elements of project cost estimation. 1. Labor cost, wages, and effort of team members involved in project work. 2. Materials and equipment, cost of physical and digital resources, permits, software, etc. 3. Facilities, expenses for rented spaces, utilities, infrastructure. 4. Vendors/contractors, payment to external service providers. 5. Risk reserve, contingency funds to handle unexpected issues. Importance of cost estimation. 1. Accurate planning of activities, resources, and schedules. 2. Improved profit margins by preventing budget overruns. 3. Efficient resource management throughout the project life cycle. 4. Better client trust through transparent budget communication. 5. Good reputation and repeat business by delivering projects on time and budget. Process of cost estimation. 1. Define the purpose and scope of Estimate 2. Develop an estimation plan and Team 3. Define project characteristics and requirements 4. Select estimating approach, WBS-based 5. Identify rules, assumptions, and constraints 6. Collect historical and cost-related data 7. Develop point estimate for each WBS element 8. Conduct sensitivity analysis for cost drivers 9. Perform risk and uncertainty analysis 10. Document the estimate clearly 11. Present to management for approval 12. Update and revise estimation as project progresses. Cost estimation techniques. Technique. Description. Analogous estimation. Statistical modeling. Uses cost data from similar past projects. Uses historical and statistical data models for estimating. Bottom-up estimation. Top-down estimation. Estimates each task separately and consolidates costs. 3-point estimation. Reserve analysis. Budget is fixed first, then broken down into components. Uses optimistic, pessimistic, and most likely values. Adds contingency funds to handle uncertainties. K6. Working capital. Working capital refers to the capital required to meet the day-to-day operating expenses of a business. It is used for routine payments such as wages, raw material purchase, payment to creditors, and other short-term operational needs. Since it is used for short-term purposes and can be easily converted into cash, it is also called short-term capital. Working capital is calculated as the difference between current assets and current liabilities. Efficient working capital management ensures smooth business operations, proper liquidity, and improved profitability. Concepts of working capital. Gross working capital represents total investment in current assets. Includes stock, debtors, cash, bills receivable, etc. Formula. Gross working capital equals total current assets net working capital. Difference between current assets and current liabilities indicates liquidity position of the firm. Positive NWC equals CACL. Negative NWC equals CACL formula. Net working capital equals current assets minus current liabilities. White heavy check mark comparison of types of working capital. Type of working capital. Meaning/description. Gross working capital. Example/key point. Total value of current assets owned by the business. Net working capital. Positive working capital. Difference between current assets and current liabilities. Stock, debtors, cash, bills receivable, etc. Formula. NWC equals CA minus CL. Current assets are greater than current liabilities. Good liquidity. Business can easily pay short-term obligations. Negative working capital. Current liabilities are greater than current assets. Poor liquidity. Business may face difficulty in paying short-term debts. Permanent working capital. Minimum level of WC required at all times to continue operations. Temporary/variable working capital. Extra WC needed during seasonal or special business activities. Needed throughout the year, e.g. stock, wages, basic expenses. Needed during festival season, new order, or sales growth period. 1. Working capital equals current assets minus current liabilities. 2. Gross WC equals total current assets. 3. Net WC shows liquidity and financial health. 4. Positive WC means good short-term financial position. 5. Negative WC means risk of cash shortage. 6. Permanent WC is always required to run daily operations. 7. Temporary WC is required only for peak seasons or special demand. 8. Efficient WC management ensures liquidity, smooth operations, and profitability. Needs/importance of working capital. 1. Ensures uninterrupted supply of raw materials for production. 2. Helps in timely payment of wages and operating expenses. 3. Enables efficient utilization of fixed assets. 4. Builds goodwill by ensuring timely payment to creditors. 5. Prevents undercapitalization and financial problems. 6. Helps purchase raw materials even during low periods or market depression. 7. Allows timely payment of dividends and interest, boosting investor confidence. Conclusion. Working capital is vital for smooth business operations, maintaining liquidity, and ensuring profitability. Proper management of working capital improves efficiency, builds trust with stakeholders, and supports sustainable business growth. Unit 2 Summary. 1. Fund/funding, money required to start, operate, and grow a business or project, used for production, marketing, hiring, etc. 2. Sources of funds (SOF), the origin of money for business activities, classified by time period, ownership, and generation source. Long-term, shares, debentures, medium-term, bank loans, leasing, short-term, trade credit, overdraft, owner's funds, share capital, retained earnings, borrowed funds, loans, debentures, internal, profits, asset sales, external, banks, investors. 3. Types of funds: government grants, partner funding, loans, investor funds, donations, crowdfunding, revenue funding, and selling up. 4. Risk, an uncertain event that may positively or negatively affect project objectives, measurable and manageable through estimation. 5. Uncertainty, a condition with incomplete information where outcomes and probabilities are unknown and unpredictable. 6. Types of project risks: operational, security, legal, strategic, performance, and market risks. 7. Types of uncertainty: variation, foreseen uncertainty, unforeseen uncertainty, and chaos. 8. Risk management process: identify risks, analyze risks, evaluate/rank, treat, avoid/mitigate/transfer, monitor, and review continuously. 9. Capital budgeting, process of evaluating and selecting long-term investments in assets/projects to maximize returns and shareholder value. 10. Phases of capital budgeting, planning, analysis, selection, financing, implementation, review/control. 11. Advantages of capital budgeting: improves investment decisions, controls expenditure, reduces risk, and increases profitability. Disadvantages: based on estimates, involves high risk, and ignores qualitative factors. 12. Project cost estimation, predicting total project expenses, labor, materials, equipment, vendors, risk reserves, to prepare accurate budgets. 13. Cost estimation techniques, analogous, statistical modeling, bottom-up, top-down, three-point estimation, and reserve analysis. 14. Working capital, capital needed for day-to-day operations, difference between current assets and current liabilities. Gross WC, total current assets, net WC, CA, CL, permanent WC, always required temporary WC, needed during seasonal demand. 15. Importance of working capital: ensures liquidity, smooth operations, timely payments, and overall business stability and profitability. Funding provides money sources tell where it comes from. Risk and uncertainty affect outcomes. Capital budgeting chooses long-term projects. Cost estimation plans budget. Working capital keeps business running daily. Unit 3. Project report and finance. K1. Projected financial statements, its limitations, meaning and